to outline a new sub-science that shall be known as the theory of investment value and that shall comprise a coherent body of principles like the theory of monopoly, the theory of money, and the theory of international trade, all branches of the larger science of economics, is the first aim of this book. To relate the abstract principles of economics to the practical problems of investment, and to show how the theories of interest, rent, wages, and profits, taxes, and money, can be applied to the evaluation of stocks and bonds, is another aim of this book. To examine certain economic consequences of the New Deal so far as the investor is concerned, and to determine the most important questions on which investment policy today must rest, is a third aim of this book. These last two aims, however, are but incidental to the primary purpose of codifying the theory of investment value and making it into a department of economics as a whole. While this book is addressed primarily to the intelligent investor and the professional investment analyst, it is hoped, nevertheless, that it will be of interest to the economic theorist also, because of what it has to offer on long and short-term interest rates, liquidity preference, uncertainty and risk, the future of interest rates, the likelihood of inflation, the proper response of stock and bond prices thereto, the behavior of markets, the formation of stock prices, the liaison between speculative commodity and security prices, the incidence of various taxes, and other questions of theory. Investment value, defined as the present worth of future v-preface dividends, or of future coupons and principal, is of practical importance to every investor because it is the critical value above which he cannot go in BU5DNG or holding, without added risk. If a man buys a security below its investment value, he need never lose, even if its price should fall at once, because he can still hold for income and get a return above normal on his cost price. But if he buys it above its investment value, his only hope of avoiding a loss is to sell to someone else who must in turn take the loss in the form of insufficient income. Therefore, all those who do not feel able to foresee the swings of the market and do not wish to speculate on mere changes in price must have recourse to estimates of investment value to guide them in their buying and selling. Dedicated as it is by its very title to the intrinsic or ultimate worth of investments, this book cannot help but imply as a corollary, however, a theory of speculation also. If marginal opinion, not intrinsic value, determines market price, as claimed in this book, and if changes in opinion, but nothing else, cause changes in price, then those who trade in the market for a living will find herein a philosophy of their work. Nevertheless, the book is not a manual of rules for speculators, nor are the estimates of investment value reached in its case studies intended as forecasts of the next move in stock prices. A pioneer step in the measurement of intrinsic value was taken several years ago in a book entitled Stock Growth and Discount Tables by S. E. Guild, R. G. Weiss, Stephen Hurd, T. H. Brown, and other collaborators. A further step was taken recently by G. A. D. Preinreich, in the mathematical appendix to his book, The Nature of Dividends. The present book follows the same trail still further, and shows in particular how the dividends a company will pay in the future can be forecast, either by algebraic budgets, using estimates concerning the future growth, earnings, and capital structure of a company, or by other methods. Although the book makes frequent use of simple algebra, facility with this subject is needed only by those specialists who focus their attention on Part 2. All others can read the rest of the book without knowledge of mathematics. Any symbols that are likely to trouble the non-technical reader are carefully explained when first introduced. The mathematics is not to be considered as a drawback to the analysis, however, nor as a method of reasoning which serious students can afford to neglect. Quite the contrary. The truth is that the mathematical method is a new tool of great power, whose use promises to lead to notable advances in investment analysis. Always it has been the rule in the history of science that the invention of new tools and new methods is the key to new discoveries, and we may expect the same rule to hold true in this branch of economics as well. That investment analysis until now has been altogether unequal to the demands put upon it should be clear from the tremendous fluctuations in stock prices that have occurred in recent years. As will be shown in the post-mortems in Book 2, proper canons of evaluation, generally accepted as authoritative, should have helped to check these price swings somewhat, and thereby reduce in some degree the violence of the business cycle, to the benefit of all the world. October 1, 1937. J. B. W. Acknowledgements. I wish to express my gratitude to Professors Joseph A. Schumpeter, Wassily W. Leontief, and Shaw Livermore for criticisms of the entire manuscript, and to Mr. C. L. Weaver for a final check of the mathematics. Others who have read various chapters and offered helpful comments include Mr. J. L. Hawley, Mr. A. C. Patton, Mr. Gustav Burke, Mr. Gladden W. Baker, Mr. Edward Milligan, and Mr. George C. Long, Jr. Miss Pearl Cohen has prepared the index. To Harcourt, Brace and Company, Inc., Professor Edwin W. Kemmerer, The Macmillan Company, Dr. Gabriel A. D. Preinreich, and The Spectator, I am indebted for permission to quote from copyright material. J. B.W. Book I. Investment Value and Market Price, blank. Part 1. Speculation in the Stock Market, blank. Chapter I. The Difference Between Speculation and Investment. I. Real worth and market price, separate and distinct things not to be confused, as every thoughtful investor knows, are real worth and market price. No buyer considers all securities equally attractive at their present market prices, whatever these prices happen to be. On the contrary, he seeks the best at the price. He picks and chooses among all the stocks and bonds in the market until he finds the cheapest issues. Even then he may not buy at all, for fear that everything is too high and nothing will give him his money's worth. If he does buy, and buy as an investor, he holds for income, if as a speculator, for profit. But speculators as a class can profit only by trading with investors, to whom they can sell only for income. Therefore, in the end, all prices depend on someone's estimate of future income. Of investment value in this sense, some men will make one estimate, others another, and of all these estimates only one will coincide with the actual price, and only one with the true worth. Our problem, therefore, is twofold: to explain the price as it is, and to show what price would be right. Part 1 of this book will deal with the first question. Part 2 with the second. 2. Definition of an investor. As will be shown later, the longer a buyer holds a stock or bond, the more important are the dividends or coupons, investment value and market price while he owns it, and the less important is the price when he sells it. In the extreme case where the security is held by the same family for generations, a practice by no means uncommon, the selling price in the end is a minor matter. For this reason, we shall define an investor as a buyer interested in dividends, or coupons and principal, and a speculator as a buyer interested in the resale price. Registered thus, the usual buyer is a hybrid, being partly investor and partly speculator. Clearly, the pure investor must hold his security for long periods, while the pure speculator must sell promptly, if each is to get what he seeks. If the investor chooses his holdings wisely, he can make quite as much money as the speculator. In fact, he can probably make more, or so it would seem from the history of great fortunes. But to buy when a security goes below its true worth, and to sell when it goes above it, is not enough to constitute wise investment, for such a policy would put the buying and selling points very close together, and in the end would yield no more than pure interest on the fund so invested. Wise investment requires that only such issues as are selling far below their true worth should be bought. Then, as large income payments are received in subsequent years because things turn out better for the security than most people expected, a handsome return on the principal can be enjoyed. For the traditional view on this point, see Benjamin Graham and David L. Dodd, Security Analysis, New York and London, McGraw-Hill Book Company, Inc., 1934, Chap IV. Distinction between investment and speculation. It would be misleading to leave the reader with the impression that speculation and investment together exhaust the subject of security profits. Not all fortunes founded on stock market operations are obtained by either skillful investment or adroit speculation, for other procedures of a less defensible sort, which fall outside the range of our discussion, are resorted to sometimes. For instance, promoters at times succeed in erecting some sort of monopoly that will stand for a while, and then they proceed to capitalize the high earnings that result, and sell huge issues of bonds and stocks to savings banks, insurance companies, employees, customers, and the general public. In this way, the original owners of the monopoly get out from under. By shifting the load to a big group of innocent security holders, they so strengthen the monopoly politically that it is in no danger of falling down on anyone as a result. The innocent buyers do not find themselves defrauded, and the promoters need not reproach themselves for selling bad securities, for such securities are not bad, they are just as good as any others, and their owners are not cheated. It is only the customers who suffer, for it is they who have had a monopoly foisted upon them so skillfully that they cannot get ND of it. In practice, it is very hard to pick out these monopolies with certainty. The mere fact that insiders have sold out to the general public is, of course, no proof that they have sold out a monopoly. This particular stock market procedure is mentioned only in passing, however, and will not occupy us henceforth, since it stands apart from our own inquiry, for an account of an actual monopoly of this sort. Elliott Jones, The Anthracite Coal Combination TN, the United States. Carroll PNDGE, Mass., 1914. Speculation and investment. Nowadays, rich men are being forced by the income tax laws to be investors instead of speculators. So heavy now are the surtaxes on stock profits that wealthy men often will not run the risks entailed in speculating for quick gains, with most of the profit in good years going to the government, but all of the loss in bad years falling on themselves. To avoid such unfair odds, rich men are being forced to hold their stocks for 5 or 10 years, so as to bring their taxable gains down to 40 or 30% of their total gains. Seeing that taxes load the dice against quick profits and make speculation a losing game, these men are falling back on investment. As investors, they are looking to dividends during a long period to bring them their profits, because profits of this kind come in small installments and are not caught in the net of high surtaxes. As a result of the federal income tax law, therefore, rich men, in a purely practical way, are finding themselves confronted with precisely the problem which we ourselves have set out to investigate entirely as a question of economic theory. Namely, what is the investment value of a given security? In any science, the choice of definitions is a matter of convenience. For reasons that will be given in due course, we shall see fit to define investment value, therefore, as the present worth of the future dividends in the case of a stock, or of the future coupons and principal in the case of a bond. Investment value and market value. The definition for investment value which we have chosen is in harmony with the time-honored method of economic theory, which always begins its investigations by asking, what would men do if they were perfectly rational and self-seeking? The answer is that rational men, when they buy stocks and bonds, would never pay more than the present worth of the expected future dividends, or of the expected future coupons and principal. Nor could they pay less, assuming perfect competition, with all traders equally well informed. Such a price is what we have already defined as the investment value of a security. In thus choosing a definition in harmony with standard economic methodology, we have cleared the way for the same sort of deductive reasoning in this new branch of economics as has proved so successful in the older branches like the theory of international trade, the theory of value, and the theory of distribution. Before taking up the main thesis of this book, let us pause, however, to clear the ground of certain troublesome misconceptions, and let us digress to discuss the question of speculation in the stock market first. In other words, before asking what the price for a given security should be, let us stop to explain how the price comes to be what it is. In this way, the reader will become more familiar with the distinction between investment value and market price, and will find it easier to accept the premises of Part 2, dealing with the pure theory of investment value. See Chapter 3 for a discussion of differences of opinion concerning the future. Blank. Chapter 2. Does the stock market predict the future? The alleged mind of the market, Nike, a ghost in a haunted house. The notion of a soul possessing the market and sending it up or down, with a shrewdness uncanny and superhuman, keeps ever reappearing. In the field of financial speculation more than anywhere else, people seem to believe in a social mind, or collective intelligence, a mind above and apart from the minds of individual traders, and greater than the mind of any one of them in the range of its knowledge and the sureness of its judgment. Although this animistic notion of a market mind is seldom set forth explicitly, it is often met with implicitly in theories to explain the lead and lag of different indices of the business cycle. People say that, since speculative prices move first, business volumes second, and interest rates third, the reason why speculation precedes everything else must be that speculators as a class can foretell, even though speculators as individuals cannot, the course of business months ahead. Let us see if this collective power of divination actually exists. Unless it can be proved that stock prices turn up or down before any other business index, it cannot be maintained that the stock market foresees the future of business with the help of nothing but its own supernatural intuition. While if something else can be found that moves as soon as stocks, or even sooner, then this soothsayer will stand convicted of quackery, and the trick of its prophecies will be seen to be simple enough for anyone to use. This last is in fact the case. There does exist a business series, to be described below, that moves as soon as, or even sooner than, stocks, and one which any novice can follow if he can only get access to it. Hence we must conclude that the speculative fraternity as a class has no greater ability to foresee business conditions than have well-informed transfers as individuals. 2. Bookings and stock prices. The business series referred to above, which moves even sooner than stocks, and which displays even longer forecasting power, is called orders received, or bookings. It leads all other series in the business cycle. Why should it not? Orders must be booked by the salesman before goods can be made in the factories, or receivables financed by the banks. Naturally, orders move first, business volumes next, and interest rates last. Stock prices only do their best to keep up with orders. If everyone, from customer to salesman and from sales manager to president, is looking for a chance to make money in the stock market, then enough stock may be bought or sold today for the ticker to disclose now the change that took place in bookings yesterday. If not, and if insiders are lethargic, then several weeks may have to pass before word will circulate that business is going to be better or worse, and several weeks, therefore, may elapse before stock prices turn up or down. Chart No. I compares the price of steel common with the bookings registered of the Steel Corporation. It shows that chart I. See bookings more often lead than follow stock prices, and that bookings are a better forecaster of stock prices than are either the rate of operations or the price of scrap, two other well-regarded business indices. The rate of operations never precedes stock prices, and scrap prices seldom do, but bookings often do, as the chart shows. From this we may conclude that it is bookings, or new offers, that is the principal force at work to turn stock prices up or down, and that it is access to information on bookings that causes an important group of individuals to buy and sell. It is clear, therefore, that a satisfactory explanation of the apparent forecasting powers of the stock market with regard to general business conditions can easily be made without recourse to any occult theories of social psychology that ascribe the market's power of prophecy to some superhuman intuitive faculty of the group mind. Chapter 3 Marginal Opinion and Market Price. The price of a stock as it is, not as it should be, was discussed in a very practical way in the preceding chapter, where it was shown that new business booked was the main cause of the ups and downs of prices in the market. In the present chapter, let us continue to discuss the price as it is, but let us now drop the exclusively practical tone of the preceding chapter, and proceed to deduce a logical theory of market prices and changes therein. The market for a single stock. Let us assume for the moment that the market contains only a single stock, and that none but investors buy and sell shares of this issue. Concerning its true worth, every man will cherish his own opinion. As to what price really is right, time only will tell. Time will not give its answer all at once, though, but only slowly, word by word, as the years go by. Nor will the last word be spoken till the corporation shall have closed its books for ever and ever. Those who bought their stock long ago will know their answer in the main by now, but those who buy now will hear theirs only in the future. Most of their answer will be given in the near future, to be sure, by their earlier dividends, for the present worth of near-by is greater than of far-off payments. But right now, in advance of any dividends at all to buyers of today, now, when all investors can merely estimate, and none can surely know, what their stock will prove to be worth in the end, The market can only be an expression of opinion, not a statement of fact. Today's opinion will make today's price. Tomorrow's opinion, tomorrow's price. And seldom if ever will any price be exactly right as proved by the event. Both wise men and foolish will trade in the market, but no one group by itself will set the price. Nor will it matter what the majority, however overwhelming, may think. For the last owner, and he alone, will set the price. Thus marginal opinion will determine market price. Always some would-be buyers will be excluded from ownership because to them the price will seem more than expected dividends can justify. These buyers will stand with cash in hand, waiting for some present owner to change his mind and sell out to them at their price. If this happens, then the quotation will fall to their figure, but if they change their own minds, then the price will rise to whatever they must bid to dislodge stock from the least optimistic present owner. The bid and asked quotations will reflect the opinions of the most optimistic non-owner and the least optimistic owner. The margin will fall between owners and non-owners, the ins and the outs, the ayes and the nays, and, at this margin, opinion, mere opinion, will determine actual price, even to the extent of values running into billions of dollars. If each man's opinion be given a weight corresponding to the number of shares he owns or could buy with his uninvested cash at the value he ascribes to the stock, then the distribution of opinion can be shown by a frequency curve like that shown in diagram I, in which V represents the true value as estimated by each investor, and N represents the number of shares to which this value is ascribed. For the stock shown in this diagram, the range of opinion is from 20 to 100, with the mode at 40. No one think the stock worth less than 20, no one more than 100, while the most common estimate is 40. Like as not this modal estimate is far wide of the truth, and certainly it is based on no such refined methods of evaluation as we shall develop in Part 2 of this book. Even though 40 is the most common estimate of V, 40 will not be the actual market price, M, for 40 is not the marginal, but only the modal, estimate. To find the marginal estimate, first reverse the curve in diagram I and make it look like that in diagram 2. This second curve shows how many shares are thought by their owners to be worth exactly 100, exactly 80, exactly 60, etc. But what we need is a different curve, a curve that will show how many shares are esteemed to be worth 100 or more, 80 or more, 60 or more, etc. To draw such a curve, one should begin by noting that no shares are considered worth 100 or more, because none are considered worth exactly 100. Hence the new curve must start at 0 for 100. To show how many shares are thought to be worth 80 or more, note how many are considered worth 99, 98, 97, and so forth, down to 80, and plot the sum. To show how many are thought to be worth 60 or more, note again how many are considered worth 99, 98, 97, and so forth, down to 60 this time, and plot this larger sum. In this way a cumulative frequency curve, or ogive, can be constructed from the same data as yielded the original curve for the distribution of opinion. The resulting ogive will be as shown in diagram 3. This diagram should now be rotated clockwise 90 degrees, as shown in diagram 4. The shaded area which is introduced into the new diagram will be explained presently. This last curve looks like a demand curve, and is one. To find the actual market price, M, lay off on the horizontal axis a distance equal to the total number of shares outstanding, and erect a perpendicular from this point, cutting the curve V equals F, N, in the point M. This point represents the market price of the given unalterable supply, and corresponds to the marginal opinion regarding the worth of the stock. It is evident from the foregoing description of how the demand curve is formed that the shape of the curve at any moment d caret ends upon the state of opinion at that moment. Hence, the publication of any news that changes opinion likewise changes the shape of the demand curve and the height of the curve at the margin, and thus the price of the stock in the market. The demand curve for shares as thus drawn differs in certain ways from that for a consumer's good like clothing. In the first place, each and every share owned by any one man retains the same value in his estimation. No matter how large his holdings become, there is no decline in value to him such as would occur with clothing, for instance. the marginal utility of which would become less and less the more completely his needs were satisfied. Registered in the second place, the inner reaches of the demand curve are never called into play to determine the price, because the number of shares outstanding is fixed once and for all, and no such changes in quantity occur from time to time as take place with a commodity like wheat or cotton. When the price of a stock moves, it moves because the demand curve itself moves, not because the quantity changes. In general, it is true that stock prices are altered by a change in the business outlook, causing a shift in the demand curve, while commodity prices are altered by a change in the quantity supplied, causing a movement of price along an unshifting demand curve. The chart for stocks as drawn in diagram 4 depicts a case where 5,500,000 shares are outstanding and held by owners, while non-owners stand with cash in hand waiting to buy 500,000 shares more at lower prices. The amount of uninvested cash is shown by the area of the shaded strip. According to the diagram, in this case liquidation by owners seeking cash could proceed in an orderly manner until 500,000 shares had been disposed of, and the price had declined along the demand curve to 20. After that, the bottom would fall out of the market, unless other present owners borrowed money to buy stock on margin, something we have not provided for in our assumptions up to this point. 2. Marginal opinion and bond prices. With bonds, as with stocks, prices are determined by marginal opinion, but with bonds, if they are good bonds, no question regarding the size of future payments can arise, and investors can therefore confine their attention to the question of the interest rate to use in discounting the known future payments. Concerning the right and proper interest rate, however, opinions can easily differ, and differ widely. Some investors will believe that a low rate will equate the supply and demand for savings, others, a high rate. As to who is right, time only will tell. Hence, those who believe in a low rate will consent to pay high prices for bonds, and will promptly invest their cash as soon as it is saved, while those who believe in a high rate will insist on low prices, and will persistently hoard their savings in cash, unless prices already are low. Thus, investors will be bullish or bearish on bonds according to whether they believe low or high interest rates to be suitable under prevailing economic conditions. As a result, the actual price of bonds, and the level of interest rates implied thereby, will represent, not the true equilibrium between the supply and demand for savings, but only the supposed equilibrium. The market rate will thus be only an expression of opinion, not a statement of fact. Today's opinion will make today's rate, tomorrow's opinion, tomorrow's rate, and seldom if ever will any rate be exactly right as proved by the event. Keynes, taking note of this very diversity and spread of opinion, seeks in his latest book to overthrow the orthodox theory of interest invoked above and replace it with an entirely new theory of his own. This new theory of his uses the term liquidity preference to describe the attitude of those investors who are bearish and expect to see bonds decline because of a future increase in the rate of interest. Keynes argues that the rate of interest must always be low enough and the price of bonds high enough to make some investors bearish, and make them willing, therefore, to hold cash instead of bonds. The more the bank deposits of the nation are increased by the central banking authorities, says Keynes, the more the rate of interest must fall and the more the price of bonds must rise to create enough bears to absorb the redundant deposits outstanding. Hence, to Keynes's mind, the rate of interest prevailing, both long and short term, is mainly dependent on the quantity of idle money outstanding. Translating his argument into our own terms, we should say that an increase in the quantity of money necessitates the redrawing of the frequency curve showing the distribution of opinion concerning bonds, because this curve, as defined above, must always represent the opinion of all those who either I. own bonds already or 2. have cash available for their purchase, with the result that any increase in the quantity of idle money tends to increase the number and importance of those investors who belong to the second class above. If the frequency curve is redrawn as required by the new distribution of opinion among investors, the ogive will change as a result, and so will the demand curve. Then, when the fixed supply is measured off as before, the position of the margin will be found to have shifted, with marginal opinion giving a higher price for bonds of the same quality. Thus, Keynes is quite right in saying that the quantity of idle money affects the market rate of interest. But it should be remembered that the quantity of idle money is only one of several factors at work, and it is by no means the main factor. As always, the frequency curve of opinion will reflect the beliefs of various investors as to what is the equilibrium rate of interest that will succeed in equating the demand and supply of new savings. Every man will have his own opinion on this question. The quantity of money will only determine whose opinion will be the marginal opinion. The quantity of money in itself cannot set the rate of interest, therefore, because there must be a frequency curve of opinion in the first place for the quantity of money to modify. Hence we are forced to conclude that Keynes does not disprove the classical theory of the rate of interest, but only perfects it. 3. Brokers' loans and stock prices. Let us now introduce the further assumption that buying may take place with borrowed money, and let us make at the same time certain other changes in our description of the group of non-owners who are potential buyers at a lower price. Let us assume that in the beginning no one has any cash for investment, and that the universe of those who cherish an opinion about the stock in question comprises none but owners. Then the demand curve is drawn would come to an abrupt end at equals 5,500,000, and no one could liquidate his stock and get cash for it if he wanted to, because there would be no cash buyers. Then let us further assume that the practice of making brokers' loans, for the account of others, is now introduced, so that some of the present owners can buy more stock by giving interest-bearing promissory notes to such of the other owners as will sell out to them. Then parts of the intramarginal sections of the demand curve will be enlarged, and a new curve will emerge, as shown in diagram 5. In this diagram, the solid curve is the old demand curve, the dotted one, the new. The right-hand shaded area is the amount of promissory notes accepted by the sellers, while the left-hand shaded area is the amount of loans contracted by the buyers. Both areas are equal, of course, because both stand for the same debt, the right-hand area being the asset, and the left-hand the liability aspect of the debt. Not alone on the bullishness of the buyers, however, but also on the bearishness of the sellers, does the total amount of the debt depend, for sellers will demand an adequate margin on their loans. If the market price after accumulation by the bulls is $38, then the sellers will grant loans of $20 a share, let us say, with this stock, which they consider to be selling rather high, as collateral. Some bulls may not care to risk borrowing the full amount allowable, because they may fear intermediate declines in the stock, and hence the loan area on the left will exhibit a sloping top as shown, with the largest loans being asked as a rule only by the most rampant bulls. To the marginal investor, it will be indifferent whether he invests in stock or in promissory notes, for in his opinion each will yield him the same return over a period of years. Intra-marginal investors, however, will prefer stock to notes, while extra-marginal investors will have the opposite preference, the preference for the one or the other being founded on each man's view of the dividends to be paid by the stock. The rate of interest used in discounting these dividends will be the rate obtainable on the promissory notes, since the interest rate, exclusive of risk, must be uniform throughout the investment market. If the interest rate on notes is expected to vary over time, then the annuity of dividends will be discounted at a variable rate. In the equilibrium just described, the location of the margin between those who own stock and those who own notes will determine the market price of the stock. In diagram 5, this margin is depicted by the vertical line running through the point n equals 5,500,000. This line cuts the demand curve at a level which gives the new price of $38 a share, as shown by the dotted horizontal line. Except in one particular, the location of this margin depends only on the opinion held by investors concerning the ultimate worth of the stock, which particular is the risk of short-term declines in the stock. If a bull thinks the stock is worth 60 but may easily fall from 38 to 25 before going up to stay, he will not dare borrow $20 on the stock now, regardless of how sure he is of its ultimate worth. If the speculative outlook changes, however, so that he becomes convinced that recessions in price are unlikely, then he will borrow heavily to buy, even though he may not have changed his opinion at all as to the true worth of the stock in the end. In borrowing to buy, he will alter the shape of the demand curve in the way already described, and will change the location of the margin. Market price will then still be determined by marginal opinion concerning ultimate value, but the location of the margin will be affected by further opinions, on the part of certain intra-marginal owners, concerning the risk of intermediate price declines. Thus, it is possible for an accession of confidence regarding the immediate future to cause a rise in prices, or a loss of confidence, a fall in prices, even though people may in no way alter their views concerning value as such in the long run. Throughout all of the present discussion, it is never assumed that bears sit with mere cash in hand waiting to repurchase at their own lower prices. To keep the proceeds of their sales in cash would entail the loss of interest on their money, since demand deposits now receive no interest. Therefore, bears may be expected to invest their cash in loans of some sort. Even in 1929, when interest on demand deposits was still being paid, it was more profitable to reinvest the proceeds of stock sales in call loans, commercial paper, or other short-term securities free from price fluctuation, than to leave the money in cash. And nowadays, when no interest at all is allowed on demand deposits, only those bears who are bearish for a few days only, who are mere in-and-out traders, may be expected to refrain from buying interest-bearing paper of some sort, and only they will immobilize bank deposits by their actions. In the discussion to follow, the term bank assets will be used to mean commercial paper, collateral loans, and short-term government bonds, such as would thus be bought by all investors who feared a decline in stock prices, and such as can be sold back and forth between banks and individuals without capital gains or losses to either party. 4. Brokers' loans and interest rates. In the United States, where loans for the account of others are prohibited, the investor cannot exchange stock for promissory notes, or vice versa, with other investors, and get the same rate of interest at the margin on the one or the other. If a bull borrows and buys from a marginal investor, the seller cannot turn around and loan directly to the buyer, but he can do so indirectly, by using the proceeds of his sale to buy bank assets like acceptances, commercial paper, treasury bills and notes, and so forth. Sale of these assets by the bank enables and impels it to invest in brokers' loans instead, and through the brokers the funds reach the original bullish buyer of stock. The interest rate which the banks will charge on brokers' loans can hardly be less than what they received on their assets just sold, else they would not have sold. It can hardly be more, unless the clearinghouse can maintain a monopoly price. The amount of money the bulls will borrow depends in no wise on the price they must pay for it. Strange, but true, however contrary to the general rule in economics. For the bulls, since they consider their stock worth more, in terms of future dividends, than its present market price, will feel they can afford to pay for their borrowed money an interest rate in excess of the market rate. But why, one may ask, does not their bidding for funds drive up the market rate to some point of equilibrium where they will feel it is no longer worth their while to borrow anymore? The attainment of equilibrium in such a way is what ordinarily happens in the economic world. In this case, however, it does not happen. There are two reasons why it does not happen, either of which by itself would be quite sufficient to keep the rate down. These reasons are as follows. First, lenders do not dare loan the bulls too much money. They dare loan only a modest fraction of the market price. The bulls likewise do not dare borrow too much. Most bulls will not borrow at all, but prefer to own their stock outright. Even in the boom of 1929, brokers' loans did not quite reach 10% of the market value of all listed stocks. Because collateral loans, if thinly margined, are dangerous for lender and borrower alike, the amount so lent is kept down, and therefore the demand for collateral loans cannot reach sufficient proportions to draw all interest rates up to an equilibrium point where the bulls will not wish to borrow any further, because the rate in itself is too high. Second, no matter if the bulls did borrow all they would like to borrow, regardless of risk, still they would not ordinarily force up interest rates in general, because money loaned in the stock market goes right through the stock market, and cannot stick there. If a bull borrows and buys, then a bear must sell and receive payment in cash to the full extent of the bull's loan. This cash the seller ordinarily invests in bank assets, and the banking system by selling some of its assets to depositors thus reverts to the same reserve ratio which it had prior to making the broker's loan the entire process, therefore, in no wise diverts savings from borrowers seeking funds wherewith to build new capital goods, and so interest rates are in no wise affected at the crucial place where the level for the money market as a whole is set. Only to the extent that sellers refrain from reinvesting the proceeds of their sales, and divert the cash to other uses, does borrowing to buy stocks tend sometimes to send the rate of interest up. If sellers mistake their capital gains for true income, and proceed to spend their profits on luxuries, then the demand for consumers' goods throughout the country will come to exceed the true income of the nation, prices will be inflated, and a boom financed by brokers' loans may get underway. The same result can be brought about by borrowing by bulls who remain non-sellers, if these latter mistake their paper profits for true income and proceed to spend these profits on goods and services paid for with borrowed money. Such borrowing, however, diverts capital from legitimate industry, only to the extent that the banks themselves fight the increase in brokers' loans by asking high interest rates and forcing borrowers who are living beyond their true income to go directly to savers as such for their loans. If this latter happens, then the inflationary aspect of the boom is curtailed, but an equally unsound condition of another sort develops, in which one group of citizens lends its savings to another group to permit the latter to live beyond its means. Economically, the process has many analogies to the current practice of taxing away the savings of the rich in order to finance doles to the poor, for both processes divert savings from the capital market, and thus tend to raise the rate of interest. The process also resembles the extraction of cash profits from the market by speculators, for speculators can acquire such profits only by trading with investors and by winning some of the current savings of the community that otherwise would have been applied to the construction of new capital goods. Extravagant living by speculators, therefore, is a form of national dissaving. If brokers' loans increase, it is sometimes a bad sign, therefore, in that it may indicate that savings are being diverted from productive enterprise. But it is also a bad sign for another reason, quite another reason, for it always indicates that someone is selling out, someone is bearish, someone thinks price is too high, and someone expects them to fall before they rise any higher. The size of brokers' loans thus measures the size of the bear party in the market. By bears is meant not simply the few who actually go short, but also the many who just sell out, yet who may be quite as firmly convinced of the unreasonableness of prices. It would be an interesting question to investigate, whether buyers on margin or sellers out are the better informed, the more level-headed, with all the wiser, sample of investors as a whole. May it not be that the man who owns a stock when low, sees it rise, and has the thrill of a paper profit, but still knows enough about general business and his own company to persuade himself that things are going to take a turn for the worse, is more likely to be right than the average margin buyer? If so, large brokers' loans are a sinister index of expert opinion. 5. Multiple stock markets. The marginal opinion concerning, and hence the market price of, any given stock is affected by opinion regarding other stocks too. If John Doe owns American Telephone, but holds an opinion concerning United States Steel as well, then he will own whichever stock he considers the cheaper, in this case American Telephone, let us say. If now some news comes out on United States Steel, such as an increase in its rate of operations, he may decide that steel is the cheaper, and wish to switch his investment. John Doe then sells Telephone to a marginal non-owner, Mr. Wiseman, and uses the cash thus obtained to buy steel from a marginal owner, Richard Roe. Richard Roe then becomes a marginal non-owner of steel, replacing the original marginal non-owner of Telephone, Mr. Wiseman, and invests the proceeds of his sale in the same bank assets that the other non-owner, Mr. Wiseman, once held. The switching sends Telephone down and steel up. It causes two transactions to occur, and two sales to be recorded on the ticker tape. Sometimes the switching is even more complete, for John Doe and Richard Roe may exchange Telephone and steel with each other, and in this case neither changes from being an owner to being a non-owner. Without doubt, the vast majority of the sales reported each day represent switching transactions, and very few represent either outright accumulation by optimistic buyers and liquidation by pessimistic sellers on the one hand, or outright liquidation by marginal holders and accumulation by erstwhile bears on the other hand. Switching operations throughout the market represent a change of places among various buyers and sellers along several hundred demand curves for individual stocks. Heavy trading indicates widespread changing of opinion. Usually the day's news is reflected in switching operations, and seldom in outright accumulation or liquidation. It is wrong, therefore, to say of a market rising, on heavy volume that it shows the inrush of new money seeking investment, or of a falling market that it shows capital scurrying to safety. Such statements as these, all too common, are naive in the extreme. The correct view is that rising and falling markets show changing marginal opinion, while heavy volume shows much switching. In multiple stock markets, each stock will be held only by those who like that particular issue better than any other, and those who prefer some other stock will not be owners of that particular stock, even though they may entertain an opinion on that one along with opinions on all others. Hence, in a multiple stock market, when the curve of opinion is drawn up for any given stock, and the mode and the margin are located as already described, if the views of the holders of all other stocks are included, the margin will be found to lie to the left of the mode, rather than to the right, as in the case of a market containing only a single issue. In other words, in a multiple stock market there is a tendency for most people to think all stocks but their own too high. If most people are right in their opinion of the other fellow's investments, then it would follow that stocks in general have a tendency to sell too high, because almost every stock will enjoy some distinction of its own, and will tend to gather around itself its own special group of enthusiasts who will bid its price up too high. If every stock is somebody's favorite, then every price should be viewed with skepticism. 6. The behavior of markets. The reason why volume tends to increase in bull markets when stocks go up is simple enough. Most people prefer to switch when they have a profit rather than a loss on what they are selling. If they discover some stock that seems more likely to go up than what they already hold, they will nevertheless postpone buying it until they can show a profit on their first transaction. If they have a small paper loss at present, they will not say, "I can make up my loss quicker in this other issue." Instead, they will wait till all prices rise, and then will make their switch, proudly proclaiming, "You'll never go broke taking profits." Such behavior is illogical, of course, but it explains most of the increase in activity that occurs on the top of each rally in the general market. The same sort of illogical behavior explains the existence of so-called resistance levels in the stock market. If for some time stocks sell at a certain price, and many people buy or sell at this price, a so-called resistance level will be created, with the result that the reaction from any subsequent advance or the rally from any subsequent decline will tend to stop when this level is reached again. Thus, if a great many people buy General Motors, for instance, at 57, a resistance level will be formed at this figure, and any reaction after an advance above this level will tend to stop at 57. Likewise, if the stock goes down from 57, any rally thereafter will tend to halt at 57. The reason for this peculiar behavior of prices is the reluctance of traders to take losses. The man who bought at 57 and saw his stock rise 10 or 20 points may decide to take his profit at almost any price on the way down so long as this price is above 57, but under that figure he is reluctant to admit his mistake and take his loss, hence offers to sell become scarce below 57. Likewise, the man who sold out at 57, but saw his stock advance 10 or 20 points to the benefit of someone else, may regret his mistake, unless he has switched into something still better, and may decide to repurchase his holdings as soon as he can do so without loss, hence offers to buy become numerous under 57. The decrease in offers and the increase in bids when the reaction reaches 57 thus tend to absorb whatever forced liquidation is underway and bring the decline in prices to an end. A similar explanation will account for the behavior of the market when it meets a resistance level on the upside. The reason why old resistance levels slowly lose their holding power as time goes on is that people slowly become reconciled to their losses and become willing to buy and sell stocks on intrinsic merit instead of original cost. When enough buyers and sellers at the old resistance level come to realize the truth of the maxim that the market doesn't care what you paid for your stock, the resistance level fades out of existence altogether. Unwillingness to take losses also explains the market's habit of declining no more than 50% of the previous advance when traders become engaged in a temporary scramble to take profits during a bull market. Followers of the Dow theory maintain that a bull market is liable to undergo a reaction of 50% of the previous advance at any time, and that such a reaction by itself does not indicate the end of the bull movement. These Dow theorists offer no reason, however, why the reaction should be limited to 50%, and so the following explanation is put forward as a suggestion. The average bull, if he is neither keener nor duller than the rank and file whose trading is causing the advance in prices, will make his first purchase at 144, let us say, his next at 149, his third at 154, and so on every 5 points up, till the very top of the rise is reached. If the top is at 194, for instance, his average cost will be 169. Under these circumstances he can sell out his entire commitment with a profit at any price above 169, but at any price below 169 he must take a loss. If a profit-taking stampede should be touched off by a sudden shock to confidence, therefore, it could run from the peak at 194 down to the midpoint at 169 before the average trader would show a loss. And just so long as traders have a paper profit, they are likely to be frightened into selling by the declining trend of the market once it starts to fall. But just as soon as they have a paper loss, they will become stubborn and refuse to sell. Hence any reaction that is spectacular at the start is likely to carry the full distance, and then come to an end of its own accord when 50% of the previous advance has been cancelled. Even if the reaction represents the beginning of a bear market, it may still run for no more than 50% of the previous advance, because bear markets and depressions are often calamities that are long overdue and are merely touched off by the profit-taking stampede. The subsequent rally after the decline requires no fresh purchasing power to bring it about, for, as already explained, prices can rise or fall in a bull or bear market merely by the swapping of securities between traders, and without the use of any cash at all, provided each trader merely switches his holding from one stock to another. If the market is beset by forced liquidation to satisfy margin calls, the buying by those who sold out earlier at higher prices when their stop-loss orders were executed will usually suffice to stem the tide, once the stampede to salvage paper profits has subsided. Therefore, forced selling need not carry the reaction below the critical point where the average trader begins to show a loss instead of a profit. In a bear market, the tendency of rallies to equal 50% of the preceding decline may be explained again by the unwillingness of investors to take a loss. But this time investors reckon their loss or gain from a different point of view. The investor in a bear market usually considers the decline only temporary, and sells out only with the idea of repurchasing at a lower price. Therefore he considers it a gain if he can buy his stock back lower down and have money left over. The typical investor liquidates bit by bit all the way down to the very bottom, with the result that his average selling price is halfway between the high and the low. If a repurchasing stampede should be touched off by a sudden piece of good news, the rally would be likely to run to the point where the average trader could no longer cover his previous sales without the help of additional cash. The rally, in other words, would be likely to run to 50% of the previous decline, and beyond that it would not go unless the news was of far-reaching importance, because the average trader hates to admit he has made a mistake. 7. Investors and speculators. So far we have discussed a stock market for investors only. Bull or bear a man may be, and still be an investor rather than a speculator, so long as he looks to dividends rather than to price changes to justify the cost of his stock. There exists another large class of traders, however, made up of speculators, whose business it is to buy and sell for changes in price alone. To these speculators dividends are inconsequential because they hold for too short a time to receive many dividends. To gain by speculation, a speculator must be able to foresee price changes. Since price changes coincide with changes of marginal opinion, he must in the last analysis be able to foresee changes in opinion. Successful speculation consists in just this. It requires no knowledge of intrinsic value as such, but only of what people are going to believe intrinsic value to be. Now opinion, when it changes, need not change for the right. It may change for the wrong, and the probability of a change for the wrong is about as great as of a change for the right. If opinion were not founded in part on current dividends and changes therein, there would be nothing to prevent price and value from drifting miles apart. That opinion may change for the wrong. Many a speculator learned to his sorrow when he sold short too soon in 1929, or went long too soon in 1932. Hence some old traders think it a handicap, a real handicap, to let themselves reach any conclusion whatsoever as to the true worth of the stocks they speculate in. How to foretell changes in opinion is the heart of the problem of speculation, just as how to foretell changes in dividends is the heart of the problem of investment. Since opinion is made by the news, the task of forecasting opinion resolves itself into the task of forecasting the news. There are two ways to do this: either to cheat in the matter, or to study the forces at work. Cheating has been outlawed, so far as can be, by the Securities Act of 1934, which tries to prevent insiders from gaining by foreknowledge of dividend changes, earnings statements, contracts let, etc., and requires these insiders to refund all short-term profits in their own stock to the treasury of their company. Certainly the old situation was scandalous, but the new law overcomes it only in part. For an officer of International Harvester, let us say, if he sees his own sales shoot ahead, could make use of this inside knowledge to the detriment of the small stockholder by buying shares of Deere & Company, for instance, whose business, he can feel sure, is enjoying the same gains, and whose earnings, when published at the end of the year, should prove a surprise to outsiders. In having access to this inside information, officers and directors have a most unfair advantage over the host of ordinary stockholders. Only stupidity or indifference, on the one hand, or great scrupulousness or recklessness on the other hand, can prevent insiders from getting rich in the market, and all that the law itself can really do is to advertise the ethics of the problem. Just because there exists a large group of traders on inside information, many outsiders base their own speculative operations on guesses as to what the insiders are doing. They watch the tape and study the chart of the market. Any slight rise in a stock, therefore, tends to provoke a further rise as outsiders rush in to buy, believing they are imitating the insiders. To this procedure there is much logic, and in the great boom ending in 1929 it proved highly successful as a rule. The other way to forecast the news, and thus the change of opinion in the movement of prices, is to study the forces at work, in the belief that coming events cast their shadows before. In this spirit of prophecy Keynes wrote his Economic Consequences of the Peace. If an economist is good for anything, he ought to be able to foresee the consequences of the NRA, the AAA, and the CIO, for instance, in our time, just as he should have been able to foresee the consequences of the wartime rise in gold prices, or of reparations, or of mounting tariffs, 10 or 20 years ago. But rare is the man so sagacious as to foresee, so certain as to believe, and so steadfast as to remember. He who is makes a good speculator. Long and detailed observation of the market in its response to news will convince one how much wiser the market as a whole usually is than the average participant in it, for the market, whatever the news it is trying to discount, always includes among its members some traders who are experts in the particular subject at issue. Thus a few traders may be experts on moving pictures, for instance, and may exert their influence on the market once in a lifetime, when a successful process for making talking pictures is finally perfected. To the outsider, strength in a certain moving picture stock may seem wholly inexplicable until months later when it becomes known that pictures using this new process have met with public acclaim. Other traders may be experts in German politics, and foresee the final triumph of Hitler, with the consequent persecution of the Jews, foreign boycotts, shrinkage of exports, and fall of German bonds. And so it goes. No one man can hope to be an expert in everything, and if he ventures to speculate outside his own special field he takes the chance of finding that he has bet not with but against the experts, for which impudence he must pay dearly. Because experts see the truth first, and are few in number, big price changes do not occur instantaneously, but only over a period of days or weeks, during which time a large volume of trading takes place. Not until the price stops changing after a piece of news has appeared can one say that this news has been thoroughly disseminated among and interpreted by investors. If the news is good, those who understand it first buy from the marginal owners, who are caught napping and who sell out, much to their own future chagrin, because they do not know enough at the time to remove their standing offers, or refrain from selling their stock when they see it go up. If the news is bad, the alert traders take advantage this time of the standing bids in the market. The preoccupied investor is often outsmarted, therefore, if he persists in placing standing orders close to the market in the hope of taking advantage of some minor dip or rally in his direction, for such standing orders are sure to be filled whenever he has guessed wrong, but are by no means sure to be filled when he is right. The policy of placing limited orders loads the dice against the non-professional trader. Every speculator's life is strewn with regrets, vain regrets for the news he did not understand until it was too late. That time and tide wait for no man, he knows full well. Opportunity, like a bird on the wing, must be shot in a jiffy, or she flies out of range forever. Hence the first speculative opinions are usually snap judgments, often wide of the mark, and as such they usually need to be revised by the later trading of those who have had time to take a sober second thought. 8. Temporary price changes. While market price is ordinarily determined by marginal opinion, it may happen at certain times that prices break away from marginal opinion temporarily, or rather, that prices reflect for the time being the marginal opinion of an unduly restricted group of buyers or sellers. During sudden liquidation, or during a panic or a corner, prices for a few hours or a day may fail to reflect the marginal opinion of any large group of stockholders or potential stockholders, because many would-be buyers and sellers may fail to have any bids or offers resting on the specialist's books awaiting execution, or may fail to react promptly and enter market orders as soon as the wave of concentrated buying or selling gets underway. Consequently, it is possible for prices to be temporarily set awry by an emergency. In the old days before the SEC, big operators, knowing this, used to raid the market, hoping to turn around before the general public could rescue the situation. Nowadays, a startling piece of news can produce a similar temporary displacement of prices, because nowadays markets are very thin, and few standing orders are to be found on the specialists' books. To illustrate this point, we might consider what would happen in the hypothetical case that a great war in Europe suddenly became imminent, with the result that everyone became afraid that the English and French governments would commandeer the American securities held by their citizens, and would force the sale of these stocks and bonds on the New York market in order to pay for supplies and munitions. While under the new margin rules the selling would not of necessity grow more intensive the more prices declined, as once it would have done, nevertheless the sudden impact of the selling would almost certainly depress prices temporarily far more than would be warranted by the mere change in marginal opinion among all investors, including those whose response to lower prices is very leisurely. Doubtless the sudden liquidation would prove so severe that the exchange would have to be closed very soon, as it was in 1914. Sudden buying or selling in smaller amounts occurs in everyday trading, and if it takes the market unawares will produce results of the same sort as those just described but of much less spectacular proportions. The minor fluctuations that occur in prices from hour to hour are probably caused more by imperfections of this sort in the response of the market to price changes than by actual shifts in marginal opinion throughout the entire country. 9. Unanimity among markets. The various speculative markets do not contradict each other. The stock market does not forecast inflation, for instance, at the same time that the bond market forecasts deflation. Therefore, those who think that stocks were high late in 1936 because inflation was feared by the stock market must be wrong, for bonds were not low at this same time as they should have been if inflation were simultaneously feared by the bond market. Concerning the argument that stocks do not deserve to rise before inflation begins, see Chapter 9. Section I concerning the likelihood of inflation occurring, see Chapter 19. While it is true that at such a time all the pessimists would hold stocks, provided stocks were legal investments for them, and all the optimists would hold bonds, nevertheless the two markets could not disagree unless there were exactly the right amounts of stocks and bonds to satisfy each group of investors. If there were too few stocks to go around, those investors who could not buy stocks would be forced to hold bonds, and would become the marginal holders thereof. Since market price is made by marginal opinion, these disgruntled bondholders, trading among themselves, would establish quotations for bonds that would reflect the fear of inflation to the same extent as the quotations for stocks reflected it. In this way, the two markets would be brought into agreement, and the law of the unanimity of markets would be fulfilled. The various speculative markets tend to go up and down together, with the same news being reflected at the same time in all markets. Thus, the markets for steel shares and steel scrap tend to turn up or down at the same time, for the same news is relevant to values in both markets. Since stock traders and scrap dealers both read the same newspapers, ordinarily they both decide at the same time that steel operations are going to increase or decrease. Moreover, each group of speculators is free to trade in the other's market if it wishes, and scrap dealers and scrap users in particular are quick to seize upon any opportunity that may present itself for speculating in the stock market. Outright arbitrage may even be resorted to. Therefore, it is not to be expected that scrap prices should move in advance of share prices, or vice versa. Instead, the two markets are normally synchronized, with prices in both markets always in the same phase. What is true in the steel business for scrap and shares is true in the oil business for crude and shares, in the farm implement business for wheat and shares, and in the banking business for interest rates and shares. The same news is reflected at the same time in all markets, hence it is unlikely that any scheme could be devised for forecasting the stock market by the prior movements of some other speculative market. The prices of speculative commodities, like wheat and copper, tend to move in phase with the prices of common stocks. It is only non-speculative commodities, like automobiles and clothing, whose prices move later in the business cycle. What distinguishes a speculative from a non-speculative commodity is the existence of a carryover or an inventory that can be bought by traders in slack times for resale in boom times. If such a carryover exists, its value will be determined in part by expected changes in demand during the business cycle, and so the same news that is relevant to speculative stocks will be relevant to speculative commodities. Therefore, in the absence of changes in supply, caused by the weather, for instance, wheat, cotton, wool, copper, scrap, and other speculative commodities will move with common stocks, and will not wait for changes in employment, wage rates, and non-speculative commodity prices, which latter normally move later in the business cycle.